Welcome, students. So, now we will learn about, with the help of some already done illustration, we will learn about how we work out the cash flows. We will prepare this kind of the sheet ourselves also at the end of the discussion. After having discussed the entire cash flow estimation conceptually, we will solve one problem ourselves also later on. But at the moment, it's already a done problem, and we will, with the help of this statement, we will learn about that how the project cash flows are estimated, or how they are brought at a level where they can be discounted against the weighted average cost of capital or a suitable R, and then the NPV or the IRR can be calculated. So, as I told you, or we have seen in the investment criteria part, that we need both cash outflows and cash inflows, because cash outflows are the investment which facilitate the manufacturing process by setting up the venture. And when we start manufacturing something or generating the service, then it goes to the market and gives us the profit, and profit when added back with the non-cash expenses, so we get the cash inflows. So in this given as information, we have the 5 years period of time, rather you can call it as a 6 years period of time. 5 years means for which the operational information is given to us, or the inflows are given to us, 1 to 5 years. And this 0 period is basically the construction period, right? In this construction period, we are making all the investments, and this is causing the outflow. This is not giving us any kind of the inflow. This is causing only outflow when we are building the project and making investment. And the first investment which we make is in the fixed assets. This is the investment we are making, and this is the investment in the fixed assets. So this is the first investment we are making. This is a major investment we are making, and this is, for example, here it is given to us rupees in millions. So the investment in the fixed assets required is 80 million. So 80 million you have to invest for building your project, for buying your land, plant, building machinery, furniture, vehicles, and all that. So this is a fixed investment, or investment in the fixed assets, first major source of the cash outflow. And then we have to make the second investment in the working capital, net working capital. Net working capital, when you calculate, you see that the current assets minus current liabilities, right? So total current assets to be built up. For your inventory, we want to have the credit sales we want to make for supporting of the credit sales, and we want to keep the cash also. We want to have the prepayments also. We want to make the advance payments also. So total will be called as the current assets, and part of the current assets then will be funded by the current liabilities. That is the sundry creditors, bills payable, or maybe any kind of the expense credit. So that will be called as a current liability. So the difference between this current asset and current liabilities is called as the net working capital. So we are going to make the estimates here for the net working capital. So this is the requirement of the net working capital is the 20 million. So 80 million is the investment in the fixed assets or long-term assets, and 20 millions of investment in the net working capital after meeting the part of the, say, working capital requirements from the current liabilities. So total investment of how much? Total investment of the 100 million we are going to make here in this venture when we are going to create the venture. Once we have set up this venture and we have say made the investment of the 100 million, so now we will start the production process or service generation process, and we have the first operating period, first year, first operational year. And in the first operational year, the first source of the, say, inflow, or maybe the, say, you call it as the inflow, is basically the revenue, means the total sales we are making in the whole of the year. This is the revenue, and from this revenue you're subtracting the cost, and that cost is other than the depreciation and interest. So this cost is going to be 80 million, and besides this 80 millions of the cost, you have to subtract something called as a depreciation, which is worth 12 million. This all will give you the profit before tax. This will give you the profit before tax. We do not subtract the interest, right? In the cash flow estimation, we do not subtract the interest, because this cash flow, when we are going to work out, for example, this is a net cash flow of 31.60 million. This is for all the stakeholders, including the lenders. So if you, for example, subtract the interest here as an expense, as a financial expense, then this cash flow left with, net cash flow left at the end of the first year, would be only to the equity shareholders. So we are not going to calculate the cash flow only for equity shareholders. We are going to calculate the cash flow for all the stakeholders, that is the debt and equity. So for that purpose, we don't subtract the interest. We only take the cost, manufacturing cost and depreciation. Manufacturing cost is largely variable in nature, and depreciation is a fixed cost. because it's a part of the, say, reduction in the value of the fixed assets. So it's a depreciation. So total cost we have here is 80 plus 12 is 92, and profit before tax comes up as 28 because total revenue is 120 million. So you get that, say you have to pay now on the tax. It's a profit before tax. 28 million is basically the profit before tax. Now you have to pay the corporate tax, and corporate tax is, for example, 8.4 million. So you are left with, after this, you are left with something which is called as profit after tax, PAT, and this is the source of the cash inflow. Because first, when we calculate the cash inflow, first we try to work out the profit from the total revenue and cost of any operating year. So profit after tax we first calculate and for calculating the profit after tax we take the revenue, and from the revenue you subtract the, say, all your operating expenses and depreciation, right? But not financial expense. So the total expenses, total revenue minus total cost becomes the profit before tax, which we have worked out as 28 million here, and minus taxes 8.4. So profit after taxes 19.6 million. We have calculated PAT. This is called as a profit after tax or PAT, and this PAT is basically the first source of the cash flow. And then we will have to we have to calculate the operating cash flow, right? There's no other expense. So we have got the PAT with us. Other things we'll discuss later on. So we have got this operating cash flow. And the operating cash flow, for calculating the operating cash flow, what you're doing is you're adding the PAT plus depreciation, right? You're adding the PAT plus depreciation because depreciation is basically a non-cash expense. Depreciation is a non-cash expense. So the cash is not moving out on account of depreciation. It's only a book entry because we have already paid this cash while we acquired the fixed asset. Now this is basically a recovery process of the investment made in the fixed assets, which can be used, this depreciation money can be used later on for the replacement of the asset. So since no cash is moving out because of the depreciation, like operating expenses. In the operating expenses, for example, if you buy raw material, you pay to the supplier of the raw material. If you have the labor, you pay to the labor. If you have any other utilities, water, power or anything, you pay to them. So cash moves out. But in case of depreciation, it's only a book entry. Cash is set aside only, and that cash is still available with us. So it's not profit, but it is cash. So profit after tax plus depreciation, and all other non-cash expenses. It can be amortization, it can be any other factitious asset. So that can be, total will be added here, and finally the profit after tax plus all non-cash expenses. In the present case, we have only depreciation of 12. So 19.6 plus 12 becomes the 31.60 as the operating cash flow, right? And this is the net cash flow also, because there is no other entry in between the operating cash flow and the net cash flow. So this is the net cash flow with us also. And in this case, we will be maybe taking this as the final cash flow at the end of the first operating period. Similarly, we work out the cash flow for the second operating period, which comes up as 31.06. Third year is 30.60, and fourth year it is 30.21. So these are the four normal operating cash flows, you can call it as that. For the first 4 years, the cash flows are available, inflows are available with us. Outflow is 100 million. That is on account of investment on the fixed as well as the current assets, and inflow for the first 4 years is the 31.60, 31.06, 30.60 and 30.21 for the first 4 years. Fifth year is the bigger cash inflow, because this is the last year of the project. After that, you are going to terminate the project, because the foreseeable value or maybe the working operational value of this project is only 5 years. We estimate the cash flows up to a foreseeable period, right? After that, we assume that we are going to, if we terminate the project, what will happen to this venture or the cash flows? So here we have calculated the cash flows normally. So operating cash flows in this year, in the year 5, are 29.88. And in this, we are adding the terminal cash flows also. So out of this investment of 80 million, you will be recovering the net salvage value of the fixed assets. Right, this 30 million will still come back to us, maybe by way of the remaining depreciation plus the scrap value, or if the depreciation is, if the asset is fully exhausted, then it may be the scrap value, whatever it is. But this asset, if you sell in the market after using for a period of 5 years, if you sell it in the market, which you bought for 80 million 5 years back, After 5 years, means for using for 5 years, and after 5 years if you sell it off in the market, so it will still give you the 30 millions of the revenue. So 30 millions will come as the salvage value from the fixed assets when we will sell it in the market, and working capital is normally recoverable in full, because working capital is investment made in the current assets like inventory. So when you close the production and you terminate the project, you will sell the entire inventory, so you will get the entire money back. Credit sales will be fully recovered. Normally in the practical sense, credit sales are not fully recovered, and even the raw material is or inventory cost is also not fully recovered, but we assume here that entire working capital is going to be recovered in full in 100%. So this is 20 millions of the working capital which we made invested here is going to come back to us. So in the terminal year or maybe the last year, two cash flows are terminal cash flows, 30 plus 20 on account of salvage value and recovery of working capital. They are terminal cash flows, and normal cash flow here is the operating cash flow is still there. So you are going to add up these three. So this plus say finally this. So you are going to get up something, and this something is called as, means the sum total of these two is the terminal cash flow of 50. We are saying here it is a terminal cash flow of the 50. This is 30 plus 20. 29.88 is basically the operating cash flow. So finally the closing cash flow or net cash flow at the end of the year 5 is the 79.88, right? 79.88, and this is what we require actually. So you see, you have now got the two series of the two set of the cash flows. One, this is a cash outflow or the initial investment in the zero period, which we were, if you remember, while calculating NPV or IRR, we were keeping on the top in the parenthesis because that is outflow. So it is 100 million is the outflow we are keeping on the top, and then after that we will be taking these inflows 31.60, 31.06, 30.60 and 30.21 and 79.88, and these 5 cash flows we will have to discount against the weighted average cost of capital or suitable R. This is a discount factor. So 100 will be treated as 100, and these 5, because they are coming at the lag of 1 year each, first cash flow coming at the end of the first year, second year, third year, fourth year and fifth year. So at the suitable discount rate R, we will have to discount these cash flows, sum the value up of these 5 cash flows, the discounted value, present value of the 5 cash inflows and the present value of the cash outflow, and then we will have to compare and calculate something, we call it as the NPV or IRR. You calculate the NPV or you calculate the IRR. So then we can say whether the project is worthwhile or not, if the NPV is minimum 0 or positive, or if it is IRR, if you are evaluating it on the basis of IRR, and IRR is equal to or more than the required rate of return, then you will accept the venture, otherwise you will not accept the venture. So in the previous analysis, you were given the cash flows ready made, but now you have to work out the cash flows in the real life as well. You have to work out the cash flows yourself from the previous information of market and demand analysis and technical analysis and other relevant information, and finally after working out these cash flows, you have to discount them and calculate the NPV and IRR, and finally you arrive at some conclusion whether this investment proposal is worthwhile or not. So this is how we calculate the cash flows, project cash flows, and you practically can see here that it's a very simple process. If there is no wrinkle in the information given, and if there is any some, you call it as a typical issue given, we will have to adjust that also. But overall, cash flow estimation process is not very complex, rather it is simple and very you call it as interesting and useful. Now we will proceed further with the say cash flow of the replacement projects. Cash flow of the replacement projects, because they are again a different kind of the cash flow, and this is normally useful, as I told you earlier, also for the existing firms when they are already there into existence, they are already working. Some maybe assets are there, means this kind of the cash flow analysis or the cash flow estimation is only relevant in case if the firm is already existing and you have certain assets. So one asset has become less useful, you want to replace that old asset with the new asset to increase efficiency of the venture or the production process. So for that purpose, because these machines are of a very heavy value, Sometimes the machine's value can be 10 crores, 20 crores, or maybe two machines if you have to replace. So it means 40 crores of the investment is required. It requires a clear evaluation whether it's worthwhile to change the machines or not change the machines or something like that. So they are called as the replacement projects. For example, when you talk about, I was just referring to you in the previous class about the Steel Authority of India Limited. It was a leading company manufacturing and providing steel to the country till the say globalization of Indian economy. But when the steel sector was opened up for the private sector participation, and mid 90s, this Jindal, Lloyd and SR Steel, they set up the high-tech steel manufacturing plants. Jindal set up a very high-tech steel manufacturing plant in south, and SR and Lloyd in the western part of the country, very high-tech and good steel plants. So they gave a big challenge to SAIL, Steel Authority of India Limited, because their plant was quite old, age old, and they were not able to replace the technology or the plants with the due course, or in the due course, or maybe with the passage of time. So when these private sector companies' product came in the market, that provided a huge competition to SAIL, and the SAIL lost the significant market share. Half of the market was lost because your western region was snatched by this Lloyd and SR, and southern region was completely say snatched from the SAIL by the Jindal Steel. So SAIL is left either by the say central India, eastern India, or maybe to some extent northern India. So almost 50% of the market is gone. And maybe from a well-functioning large sector organization, SAIL became, maybe over a period of time, short span of time of 5-10 years, it became a sick company. When it became a sick company, now it's a huge company, about employing more than 1 lakh people. So you cannot close the venture. If it is a sick company, you have to preserve the venture, you have to save the venture, because it's not the question of profit or loss, but it's an important question of saving the employment of the lakhs of the people. So government thought of revitalizing SAIL, and a number of steps were taken. Even for privatization of the Steel Authority of India Limited, they gave the global tenders also, that if somebody want to buy the company, we are ready to sell it off, but nobody came forward. Finally, this company was referred by the Ministry of Steel to the consultancy firm McKinsey International. They were requested that please study the SAIL, the overall, maybe the manufacturing process of the SAIL, causes of its sickness, and please advise us that how we can revitalize this say public sector, large public sector organization. So one out of many suggestions, they gave the suggestion that immediately you need to inject 50,000 crores for the replacement of the plants at the Rourkela, Bokaro and Bhilai plants, right? So some 20,000 crore was required for one plant at Rourkela, and again you call it as almost 10,000 crore was required for Bhilai plant, and then 20,000 crore was required for Bokaro plant replacement. So 50,000 crores of investment, they said that immediately you have to replace the old technology with the new technology, and for this replacement you need 50,000 crores if you want to revitalize the production process in the 3 plants of SAIL. So you understand now, for a SAIL, now in one say plant itself, investing 10,000 crores is a big project, or 20,000 crores is a big project, and total investment of 50,000 crores is a big project. So replacement projects are sometimes very big in nature, and they are sometimes so big that they are even bigger than of setting up of a new venture, which is by a startup, or by a new business, or by a new firm, or by a new set of the entrepreneurs. So you cannot undermine it that replacement projects are not say worth say taking into consideration. They are very big investments sometimes, but the cash flow estimation has some process to be followed here. So in this case, the simple thing is, you have to, when you are taking into considerations the cash inflow and outflow from the new asset, replaced asset, you have to factor for the cash inflow and outflow that would have come to you had the asset not been replaced, right? Or cash outflows caused by the old machine, cash inflows brought in by the old machine. So you have to take that also into consideration, and only you have to take the replacement value into account. So you have not to simply say that we are making only new investment. You are replacing the old with the new. So the effect, past effects, or maybe the future effects of the old investments also have to be taken into account. So for that purpose, you see here that while calculating the initial investment for the replacement projects, you have to take into consideration, first of all, cost of the new asset, cost of the new asset plus net working capital required for the new asset minus after tax salvage value, because that you are going to sell off in the market. So that's going to give you the salvage value to be realized from the sale of the old asset and the net working capital required for the old machine. So is there any incremental net working capital required by the new machine, or the working capital is going to remain the same? So initial investment is required only in the replacement of the fixed cost, the asset in the form of the fixed cost. So that will be worked out, total investment requirement minus the salvage value coming from the sale of the old asset. When you are calculating the operating cash flows, so for calculating the operating cash flows, you take into consideration the operating cash flow from the new asset. That's fine. But you have to, from this operating cash flow, you have to subtract the operating cash inflows from the old asset had it not been replaced. So you cannot say that only cash inflow is coming from the new machine. Had the old machine not been replaced, that would also have given you some cash inflows, maybe not as good as the new machine is giving, but you have to factor for the old machines the cash inflows also. You have to take them also into account. And similarly, for calculating the terminal cash flows, you have to take into consideration the old machine's effects also. And for that purpose, you have to calculate the after tax salvage value of the new asset, right, plus the recovery of the working capital associated with the new machine. So as we have seen in the previous example, we are calculating the terminal value, and terminal value is basically sum total of the salvage value of the old machine and maybe the recovery of the working capital, either full or proportionate. So this total has to be worked out, and from this we have to subtract the after tax salvage value of the old asset, because old asset also would have given you some salvage value, and the recovery of the net working capital associated with the old machine, right. So this, it has not to be in isolation. Means the purpose of this discussion is that say replacement cost or maybe the outflow and inflow have not to be calculated in isolation, rather they have to be taken or calculated by taking the effects of the old asset into consideration. Maybe it is an outflow or it is an inflow. Both have to be taken into consideration while working out the cash flow for, say, with regard to the new machine. And finally, the net cash flow has to be taken into account, that how much is the total investment required for replacement of the old machine with the new machine on account of the fixed asset and working capital, how much operating cash flows are coming in from the new machine, and how much would have come if the machine was not replaced. So it means you have to adjust it against the cash flows of the old machine, and same adjustment you have to do for the terminal value. So for this purpose, you have to calculate the cash flows for the say replacement assets, replacement projects, and only then you will be able to get the final net cash flow. So here is an example of the cash flow for the replacement project. So it's very clearly written. We have the three parts here: part 1, part 2 and part 3, right. So it's very clearly given here that first of all we calculate the investment outlay for the new machine. So cost of the new asset is given to you, and this is given to you in the thousands of rupees. So it is, you call it as a 1600,000 rupees of the investment is required for having the new machine. But it's not 1600,000 rupees will go in full from our pocket or from the firm's pocket. 500 rupees will come from the salvage value of the old machine also. So net investment is going to be 1600,000 minus 500,000 is 1100,000, plus increase in the working capital is going to be 100,000. So total investment is not going to be somewhere 1700,000, but only 1200,000, because 500,000 are going to come back to us from the salvage value of the old machine. This is with regard to the outflow. When we are going to work out is the 1200, we are going to calculate the total outflow we are going to make is net cash flow. When you will work out is, for example, we will make a column here. This is the net cash flow. So for calculating the net cash flow, so we will have to make a column here. So net cash flow from this is going to be how much? This is going to be 1200, not the 1700,000. So this is the outflow. And then we will talk about the second part is the operating inflows over the life of the project. So for calculating the operating inflows over the life of the project, first we will take the after tax savings in the manufacturing cost. So manufacturing cost is incurred for the previous machine also, and we are incurring for the new machine also. So the efficiency of the new machine as compared to the old machine would be helping us to reduce the cost. And when the cost will be reduced, so it means after tax savings will be there, and this is the after tax saving of the 180 million would be there, which will be adding to the cash inflows. Then we will talk about the depreciation. So depreciation on the new machine we will calculate 400, but you have to factor the depreciation for the old machine also of the 100. So the incremental depreciation is only 300, and on this 300 you have to take into consideration the tax savings on the incremental depreciation, because when the cost is going to increase, right, when the cost is going to increase, so depreciation is going to increase, because earlier the old machines the price was less, so depreciation was also less, which was only 100, but now the depreciation non-cash expense has become 400. Net difference would be here 300. So 300 your non-cash cost will increase. So when the cost will increase, the tax liability will go down. So by the tax saving would be here 120,000. So it means after tax savings in the manufacturing cost would be 180, and this because of the depreciation 120. So net operational savings are going to be, this is 300. So net operating cash inflow would be 300, which is going to be the additional cash flow coming from the replaced machine or replaced asset. And similarly for the second year also is going to be 270, 247.5, 230.6 and 218. And lastly we'll have to calculate the terminal cash flows. So when you talk about the terminal cash flows, so when you terminate the project, so against this investment of 1600,000, we will be having the terminal value on account of the fixed assets. That is we will have this terminal value of the new machine, 800 rupees. We will have the terminal value of the new machine, but old machine had been in use. If you terminate it at the moment, so it will give you some terminal value, that is the 160. So additional incremental terminal value is here only 640. This is 640 plus 100, so this is becoming 740. So terminal cash flows are becoming the 740 here, it is 740. So finally we will be miscalculating the total cash flows. So net cash flows, if you calculate it here, so it will be 300, right, for the year 1, 270 at the end of the year 2, and 247.5 in the year 3, and 230.6 at the end of the year 4, and here last year is going to be the 740 plus 218, it will be 958. So the net cash flow will be 958 here at the end of the 5th year. So for calculating the terminal cash inflows, means the net story is, for calculating the cash inflows for the replacement assets, number one, you have to bear in mind that it is for the existing firms, not for the new firms, because existing firms replace the old assets with the new assets. And when you are replacing the old asset with the new asset, effect of the old assets have to be taken into account while taking into consideration the financial effects of the new asset, whether it's a outflow, it's an inflow, total cost, total savings, total revenue, and tax impacts, everything has to be taken into account. And finally, for calculating the net cash flow, calculating the cash outflow, you will be taking the finally adjusted value of the new machine against the old machine. Inflow also, the adjusted value of the new inflows may be coming from the new machine after adjusting the inflows from the old machine for all the operating years. And same will happen in case of the terminal value as well. While you calculate the terminal value, you calculate the terminal value of the new machine, but always factor the terminal value of the old machine. And similarly, you calculate the net operating cash inflow for the last terminal year, and sum total of the operating cash flow plus the terminal value will become the net cash flow for the last year. That is, in this case we have worked out is the 958. So we will have to take the total savings in the cost. The two sources when we have taken into account is, so after tax savings in the manufacturing cost, because manufacturing cost of the old machine may be more and the manufacturing cost of the new machine will be less because it is more efficient. So 180 we are going to save on this account, and 120 we are going to save on account of the tax, because new machines depreciation is more, so your tax liability will go down. So sum total of the first years of the operating inflows is 300, next year 270, 247.5, 230.6 and 218, and this way we are calculating the net cash flow. 1200 is So actually, miss, for example, if it is a fresh investment, so how much would be the cash outflow? It would be 1700,000, but now it is 1200,000 because 500,000 are coming as the salvage value of the old machine. And similarly, while calculating the inflows from the new machine or from the new asset, so you are taking into consideration the effect of the old assets also, and that effect is going up to the terminal value. So when you are calculating the net cash flow, the effect of the old machine will also be taken into consideration along with the new machine. And finally, for calculating the total cash flows, outflow as well as the inflow, including terminal value, at every step old machines effects will be considered, and accordingly the final cash flows would be worked out. So this is how we calculate the cash flows for the replacement project. And some other important issues with regard to the cash flow estimation we will have to discuss before we discuss our practical illustration and we calculate the cash flows ourselves. But all those remaining issues we will discuss in the next class, and whatever it is left we will discuss each and everything, all the components of the cash flow estimation, so that we are very clear at the end that how we can estimate the cash flows correctly, so that we can later on discount them and calculate the NPV and the IRR for taking the final decision. So all the remaining discussion with regard to the estimation of the cash flows we will do in the next class. Till then, thank you very much.